Hello, everyone. We have arrived at the beginning time, so I suggest we get started. We'll get started on time, and hopefully we'll end just about on time. My name is Charles Bruce, and I am going to get things started here. So first, a welcome to everybody who's attending. This is the third webcast of this type that we've done. We did recently one in Geneva and one in Zurich, and we will be doing more, probably about a dozen in total in the near future. I'm going to make just some quick housekeeping points. And since the first housekeeping point was that we are going to be recorded, I can now check, yes, indeed, we are being recorded. So it is being recorded. It will be available at a later time on the ACA website as well. We will be putting everybody on mute. That will cut out background noise and things like that. We are going to try to deal with all questions. My guess is we won't be able to do all of that during this session, but ones that are not addressed today will be addressed later. And ones that go in the direction of Matt Strauss, we will make sure that they are passed to him. The last point, disclaimers, the usual disclaimers for an outing like this appear on the materials that were sent to you. So please take note of that. So having talked about those points, those housekeeping points, Max, I'd like to turn it over to you for introductions and also to get us started on the substance. Max?
Excellent. Thank you very much, Charles. So my name is Max Reed, and I am a tax attorney in Vancouver. It's my pleasure to be the host of this panel this morning Pacific time and afternoon Eastern time. We thank you all for taking the time out of your busy day to join us. My role here is going to be very limited. I have the pleasure of introducing our panel for this event. So the first speaker is Matt Strauss, and Matt is an attorney, is a tax attorney in George Holding's office, and he is extremely familiar with the proposal that is being discussed today. So Matt is going to speak first, and Matt is going to be followed by Benita Laughlin, and Benita has been doing this for probably more time than she cares to admit, but she's the head of KPMG's Global Mobility Tax Services practice in Vancouver, and her practice is it's a cross-border Canada-U.S. tax planning and tax compliance practice. Benita is going to be followed by Terry Ritchie. Terry's a partner and a financial planner at Cardinal Point Wealth Management. He's based in Calgary, but he serves clients nationally and across North America. And Terry is an enrolled agent and also has some tax background. Also joining us are Mary Louise Serrato, who is the executive director of the ACA, and then Charles Bruce, who you just heard from. So we've got a very diverse and distinguished lineup for you today. And without further ado, I'm going to turn it over to Matt, who's going to start by giving us a little bit of background about this proposal and where it's at and what he thinks it means and what he thinks its future is. So Matt, I think you're on the line. Can you hear us and kick off your remarks?
Yeah, absolutely. I'm here. Thanks, Max. So basically, this is a proposal that we have been working on for about 4 years now, since the boss got on Ways and Means Committee. His wife is English, so he's traveled over to London, and we've heard from Americans over there as he got on Ways and Means Committee about the tax problems that they had been having. So sort of tasked us with finding a solution, and and we finally got a bill out at the end of last year, and now we're looking for bipartisan co-sponsors on this to try and really push this forward. So the bill that we introduced essentially would move us from the citizenship-based taxation system that we currently have towards a system that looked more like a residence-based system like the rest of the world. Under our proposal, qualified non-resident citizens will no longer be taxed by the U.S. on their foreign source income while they are resident abroad. Under this proposal, they will still remain subject to tax on their U.S. source income, and that will be the only income that they will have to file a tax return on. They will not have to file a tax return on any of that foreign source income since they're not being taxed on it. Under this new proposal, in order to be eligible for this new tax status as a qualified non-resident citizen, these non-resident citizens will have to be, 1, a citizen of the United States, 2, have a tax home in a foreign country, 3, be in full compliance with U.S. tax laws for the previous 3 years, and 4, either establish that they have a bona fide residence in a foreign country for an entire taxable year, or that they are physically present in a foreign country for at least 330 days in a full year. And those sort of mirror the qualifications for the foreign earned income exemption. And so now, once an individual meets those tests, they can elect to be taxed as a qualified non-resident citizen, meaning that this is not mandatory. This is voluntary for those individuals abroad. And once you elect that new qualification, you will no longer have to file a U.S. tax return on that foreign source income, as I said. And now, while these individuals will not be taxed on their foreign source income anymore, they will still be subject to tax on the sale of foreign personal property that is attributable to their time before they were a qualified non-resident citizen. That is, if you held a foreign asset before you moved abroad, any gain attributable to that time that you bought it while you were resident to that time that you moved abroad, that gain will still be taxed by the United States after you sell the asset. But other than that, any foreign asset that you purchase subsequent to moving abroad will no longer be subject to tax. So I guess basically, as I said, this bill was introduced at the end of last Congress. We're going to need to introduce this bill again this Congress. We are still working with Legislative Counsel here in the House, as well as the Joint Committee on Tax, to clarify a few issues and make sure we have potential avenues for abuse locked down, as well as try and put in some transition rules for folks already abroad, because their situation's a little different, as well as to ensure some sort of glide path to compliance for that 3-year requirement, so that accidental Americans or non-willful non-filers are not sort of wiped out due to penalties, similar to a program that was put in place for FATCA. So we're still working on a few of those issues. But other than that, we're sort of in a holding period as well to see if we can get any Democrat support on this and see what sort of possible additions that they would have to the bill, or any input that they might have that might change the bill. So we're still waiting to see what sort of back and forth we might have to have, and where we might have to give a little bit. So this still could change a bit. That is a little up in the air. We are still continuing discussions with other offices to see if we can get that bipartisan support. I'm going to be meeting again with Don Byer's staff, hopefully later this week, to discuss this a little bit further, see where they are. And I know that they've had some meetings with different groups as well as their own committee staff to discuss this. So to circle up with them. There have been a few other interested Democrat and Republican offices in this, so we're hoping we can get a pretty good showing here of support and then get this thing introduced again as quickly as possible. Outside of that, we'll be asking for hearings on this through the Ways and Means Committee, which has jurisdiction over this, and hopefully having a good discussion with this, as well as hoping that we can count on you guys and the other outside groups to help us bring support to this and help get us other members on board, because as we've been doing this, we've really seen that some members don't necessarily know the issue yet, and it's sort of a big hurdle getting over that learning curve and getting members up to speed on this. So we really rely on you guys to help raise the profile of this, and I think you've been doing a great job, and we really appreciate it. So I'm happy to take any questions or answer anything I might have left out. I don't know how y'all want to play this.
Thanks, Matt. I think we're gonna hold the questions until all of the panelists, are finished, and we can have it, and then we to have a discussion between the three of you. But one question I had, just to try and provoke some further insight from you, is what I mean, you commented that many members of Congress are not aware of these issues, which I think makes sense. But what's the reaction like once you educate members? Do you think there's a willingness there and some sympathy, or do you think that people are generally in support of citizenship-based taxation? And what's your anecdotal reaction been to bring this proposal forward?
I think most members, once you finally are able to dig down into it, understand the inequity of our tax system versus the rest of the world. They see that unfairness. There are other hurdles that have to be broken down in conversations with them, because some will raise that they have the perception that this only impacts rich people, which we know is not true, given that I think it's 80% of Americans, somewhere around there, that percentage don't actually owe tax to the U.S., but they have to file taxes, and it costs them a couple $1,000s a year to do that. So once you start breaking down some of those barriers and show them that, look, it's 40% more expensive to hire an American abroad, so companies are hiring Brits or Australians or whomever to fill these jobs that Americans could otherwise be having, the arguments sort of resonate even more with them, that this is actually a middle-class problem. This is a problem to folks, Americans, hardworking Americans getting jobs abroad. And once you show them that information, they actually they're very receptive to fixing this. I think then sort of the problem is the limited bandwidth that a lot of members have and their staff has, is they have other priorities that they don't necessarily have the time to work through a full-fledged solution, which is why we're trying to get together with other Ways and Means offices to really put forward a well-thought-out solution that we can come to these members and say, look, this has been vetted. This is something that would work. Try and ease that path for them. So that's really why we've been doing this. But anecdotally, the feedback that we've heard is that folks get it. It's just really getting them to then focus and us to have a viable solution for them to sign on to.
Great to hear. One other thing that maybe you can touch on a little bit is from a policy perspective. How important is that this proposal be revenue neutral? Because in its success, or is it just going to be a fairness-based argument?
From a policy perspective, I think we want to get the best possible solution out there that will work for the most amount of people. We are also then taking into account the realistic side of this that says any tax bill needs to be paid for, and if a bill comes back with an exorbitant cost, it's not going to get done. So we have to realistically look at that, and as we're trying to balance out the policy goals of this, also weigh out the revenue impact. And we're trying to turn some of those knobs here to try and get this to revenue neutral or as close as possible, so that when it goes through Ways and Means Committee, when it goes through the House or Senate, another one of those hurdles is knocked down. Because if this thing came back with a score that was huge, it's one more reason for folks that are already maybe not paying attention to now discount it even further. So we are working towards that goal and trying to make this as close to revenue neutral as possible, while also still maintaining a policy that is effective for folks abroad. Sometimes easier said than done. Working with JCT, they're excellent. They do all the revenue estimating, but they get really technical really quick, which is also great, but can be a lot as you're trying to figure out which knob and dial to accurately turn to get the most revenue. So we're on our way. I'll say that.
And not to ask you to gaze into the crystal ball too much, but in your sort of most ambitious, wildest hopes and dreams, what would be the timeline for something like this? Is this is this, at all possible before the 2020 election, or would this be, it's a longer term project? In the best case.
That's a good question. I'm always kind of the eternal pessimist, but I think it might be extremely hard to get done before 2020. I think getting us bipartisan support, getting a bill that's close to revenue neutral would be a very big head start for us to try and get something into any vehicle that would be moving. I think the problem isn't necessarily the policy as much as that there's not going to be many vehicles that are moved out of the House and Senate, at least tax-wise, before the end of the year, or before the end of the session, rather. So I don't think, unfortunately, a lot is going to get done before 2020 elections. It might have to be after, but we want to be ready with all of our ducks in a row that if any vehicle is moving, we can take our shot to get on that thing. So I think it's a high mountain to climb, but we're going to try. I'll try and stay pessimistic, or try and stay optimistic in that regard, but I am pessimistic that anything is moving in this session.
Yeah, that makes sense, just given the political realities of a divided government. So, unless Terry, Benita, Charles, you have other questions or issues that you want to put to Matt right now, what I was going to do is move it over to Benita to give us a little bit of more technical background on the proposal and how it would impact tax advisors.
I'll just ask this question. As far as hearings go, do you see it possible to have hearings in the not too distant future?
I would hope so, but again, I'm now a member of the minority now as opposed to majority when we had when Republicans had the gavel. So we don't really get to dictate that. I don't know what Chairman Neal's sort of overarching vision for the committee looks like with regard to hearings. We certainly hope that this would fit into that schedule, and especially if we have a bipartisan co-sponsor that could also ask the chairman. We think that would be useful in getting this done, but I don't want to speculate too much on the possibilities, given that we don't really get a say.
Okay, thank you.
Thanks a lot, Matt. So now we're going to move it over to Benita, who's going to tell us about, go through on a little bit more of a technical perspective, how the legislation works and what its impact on tax advisors would be. So Benita, as I said at the beginning, is a partner at KPMG, and she's been doing U.S. Canadian tax compliance for over 30 years, and so she's got a great perspective on these issues. So Benita, over to you. And since I'm moving your slides, you have to tell me when you want me to move your slides.
Right. So thank you, and welcome everybody. I was asked to talk about the proposed legislation and the implications for tax advisors. So I'm not covering all the specific rules, but obviously they're going to come up as we're talking about some of the impact on tax advisors. And I'll just start by saying that change is always good for tax advisors because it means there's more work to do. So if we want more work, change is a good thing. So I'm going to talk about 4 different things about what would not change, and then I'm going to just talk about the compliance requirements going forward if this bill does pass, the planning opportunities going forward, and then just a few additional comments. So maybe you can change the slide. So what would not change? So the next slide. Some of the things that are not going to change are that green card holders are not eligible to be qualified non-resident citizens, so they're still deemed to be U.S. residents as they currently are, as understanding. They're still subject to U.S. tax, and they still have to file U.S. tax returns. Now, in general, green card holders are supposed to be living in the U.S., so that would kind of make sense because these rules only apply, these proposed rules only apply to U.S. citizens that live outside the U.S. But there are a number of green card holders that we work with and others as well that do live outside the U.S. and still have their green cards. And even if their green cards aren't valid for immigration purposes, they're still considered U.S. residents for tax purposes and are still required to file tax returns. So, and there's also a provision, I believe, where someone that does move outside the U.S. can get excused from living within the U.S. with their green card for a couple of years if they're being transferred for a job or some other reason. So there's still going to be work for the green card holders. The proposed rules do not eliminate the estate tax liability or obligation to file an estate tax returns for U.S. citizens that die if they live outside the U.S. So there's still the U.S. estate tax planning that tax advisors get involved in, and there's still estate tax for U.S. domiciled residents, for U.S. citizens, and non-resident aliens with U.S. situs property. So all of that type of planning or compliance will still be there. The gift tax will still apply the same as it does currently. So U.S. citizens and residents domiciled in the U.S. will still be subject to gift tax. The expatriation rules, I understand, are still going to apply. So if a U.S. citizen renounces their citizenship or a green card holder surrenders their green card, they still have to consider the impact of the expatriation rules, which can result in a U.S. tax liability to the U.S. citizen renouncing or the green card holder surrendering or their heirs also as well. And then for U.S. residents, they're still subject to U.S. tax even if they're not U.S. citizens. U.S. citizens that live in the U.S., as Matt indicated, are still going to be subject to U.S. tax on their worldwide income, which is, as he noted, basically the same in the rest of the world, that all countries tax based on residency as opposed to citizenship. And non-resident, non-U.S. citizens with U.S. source income are still going to have U.S. tax liabilities, or at least filing requirements. So those are some of the things that aren't changing. So there's still a lot of work, I believe, for tax advisors. So on the next slide, we're going to talk about the compliance requirements under the proposed rules. And so some of the things that even a qualified non-resident citizen, as Matt described, what the requirements are. They have to live outside the U.S. They have to have filed their tax returns for the last 3 years. And there's still going to be an annual election and certification that these non-U.S. resident citizens have to file every year. So there's still going to be a filing requirement, an annual election and certification. And as Matt mentioned, that they're still going to have to track gains that accrued while they were resident in the U.S. So if a U.S. citizen lives in the U.S. and moves out or moves back in, there's still going to be some gains that need to be tracked and income that needs to be tracked that was earned before the person left the U.S., before the U.S. citizen moved somewhere else. The U.S. source income reporting by U.S. citizens. So any U.S. citizen that does qualify, and if they live outside the U.S., they still might have U.S. source income, which they would still be subject to tax on. So there's that compliance requirement. And as I mentioned, estate tax returns will still be required for individuals that otherwise have to file a U.S. estate tax return based on the value of their estate, or if they're passing on their exclusion amount to their spouse. So that would be decedent U.S. citizens, domiciled residents, non-resident aliens with U.S. situs property. And same for gift tax returns, those would still be required. So that's another compliance requirement. And then the last item is, I think, kind of important because, over the last few years, the U.S., and as well as Canada, but has increased the amount of foreign reporting required, like information that the IRS wants about foreign investments held by U.S. persons, and so that was FATCA, and then there's the FBAR forms, which is a foreign bank and financial account reporting that has to be filed every year, and the Form 8938. The Form 8938 is the statement of specified foreign financial assets, and so on that form, all foreign bank and financial accounts and other information has to be reported every year by U.S. citizens that meet a threshold amount. And so these people, these qualified non-resident citizens, are probably going to be the people that have a lot of foreign financial assets because they're living outside the U.S. So most of them are going to have to file the Form 8938 and the FBAR every year because their financial assets are going to be outside the U.S. And the other things, so the foreign bank account reporting form, the FBAR, is filed separately from a tax return, but it reports all bank and financial accounts outside the U.S. if the total amount is more than $10,000. So almost everyone that's a U.S. citizen outside the U.S. has to file that form. And the 8938 has higher thresholds, but it includes foreign pension plans have to be reported on 8938, foreign life insurance, equity compensation like stock options, stock appreciation rights, restricted stock units held in foreign corporations have to be reported on an 8938. Shares of private companies that are not controlled foreign corporations or passive foreign investment companies have to be reported on an 8938. So it's a lot of work, and especially, like I said, for U.S. citizens that are resident abroad, because their assets are going to be mainly outside the U.S. And the other issue related to this is that the securities rules, and these are not tax rules, so I don't necessarily know exactly how they work, but they limit the ability for a person that doesn't live in the U.S. to have financial accounts in the U.S. So U.S. investment advisors, brokers, and Max, you might know more about this, but they can't manage money for individuals that live outside the U.S. So that just indicates that more and more U.S. citizens that live outside the U.S. are going to have their money outside the U.S. and they're going to have to file these forms every year, even if they are qualified non-resident citizens and they don't have to pay tax on their U.S. source income. They're still the foreign reporting, and it doesn't create a tax liability, but it does create work for tax advisors. So I don't know if that's good or bad, but it might be good for some people, bad for others.
So Benita, on the securities point, I think Terry will address that, as part of his presentation. But I had a question for you. On your final bullet point there, you have FBARs and 8938s. I mean, that's just the tip of the iceberg when it comes to all the disclosure forms. I mean, do you think, are U.S. citizens, under the proposal, are U.S. citizens abroad still going to have 5471s, 8858s, 8865s, and the whole, gamut of other disclosure forms, or are those gone?
Well, that's the thing. I don't know, how are you going to determine, are you going to count as a U.S. shareholder if you're a U.S. citizen that lives outside the U.S.? I don't know, right? I don't know. I haven't seen anything specific, but I think that's one of the things that's going to be more work, is figuring out what is a controlled foreign corporation or a passive foreign investment company. And there probably is, they still want to know everything you're doing, right? Have you seen it?
It would seem to me that if you, my read on it was that if you eliminate the taxation obligation on the income, but that doesn't necessarily eliminate the 6038, et cetera, and go forward reporting obligations. But I don't know. Maybe that's,
right.
Maybe that's something that has to be worked out, as part of the proposal, because one of the issues for a lot of U.S. citizens in Canada is not necessarily the tax obligation, although that does hurt quite a few people. But it's the forms, right? It's the forms
Right.
which are brutal.
No, and that's the issue. And if you still have to do all of that, then anyway, we'll talk about that a little bit more at the end. But yeah, I agree. There's still a lot of filings required, and they want to know everything about you, even though none of that income technically would be taxable in the U.S., right?
Yeah.
They're always.
So
This is Matt. Do you mind if I jump in for a second?
No, please
sure.
do.
Yeah, so some of those forms would still have to be filed under this bill. And so some of the reason for that is FBAR and FATCA have enormous political problems to changing them here in Congress. So one of the things that we hope the bill would do is eliminate the underlying need for some of these different filings, and that by doing so would make any changes to those underlying laws easier to get done here in Congress. So that's sort of our rationale for part of this, is that we know we can't change FATCA right now, but if it's no longer necessary, or FBAR is no longer necessary, we can make changes based on the fact that we're not looking at that anymore. So this is sort of, we understand that there's more to go after this, is more of a first step in some regards. So yes, some of those forms will still have to be filed.
Yeah.
Okay. And to be clear, it's not a criticism from my perspective. It's not a criticism of the proposal. It's just, it's just a comment about, like, what the exposure of Canadian resident U.S. taxpayers is. There's a paperwork for many of them. It's a paperwork problem, right? Obviously, the relief from the taxation would be substantial for many of them, but for
absolutely. And yeah, I definitely didn't take it that way, because it was definitely something we looked at when we were formulating initial drafts of this, was making changes to some of those underlying laws that require these filings. And we got a lot of pushback from committee staff and JCT about changing those right now. And so just the political pressure that was surrounding that, we figured just take a step back and do this first, and then when some of those are no longer necessary, then make that change. So
yeah, you got to do baby steps first, right?
Yeah, changing them all at once scared a lot of people up here, so we backed off.
Yeah. Oh, I know, and I think that, like, one of the examples I always give people, I always say, well, why don't we have a flat tax? That would be so much easier. And I go, well, no, most of the time is figuring out what the income is and what the filing requirements are and complying with them. Calculating the tax is the easy part. So, there's a lot of extra work other than calculating tax that we get involved in. But can you move it to the next slide? I just want to keep going so we don't.
Yeah, absolutely. Sorry, I didn't mean to interrupt you.
No, it's good. It's good. It's important. So, I mean, there would be work initially. Again, as Matt mentioned, there's a 3-year compliance requirement. So anybody that wants to be a qualified non-resident citizen has to have filed all the required returns for the last 3 years. So there's still people hiding under rocks out there that are not complying. So they might be more interested in doing that. So that would be additional work for tax advisors. And then again, when individuals are moving to and from the U.S., there's going to be U.S. compliance issues for U.S. citizens, including the sourcing of income, the allocation of income, the foreign tax credits, part year returns, and then there's also state tax returns. So moving years are going to be more complicated than they are now, at least from a U.S. federal tax perspective. And again, we still have non-U.S. citizens that invest in U.S. real estate and non-U.S. citizens that move to or from the U.S. So they're still going to have the compliance requirements that we currently have. So it's not like there's going to be no work to do for tax advisors and tax return preparers. So then let's go to the planning opportunities. A couple of slides, one more. Yeah. So again, I've kind of touched on a lot of these things and as part of the talk about the compliance, but again, there's going to be an analysis of the rules. Everyone's going to have to figure out how they work, just like we talked about, do you have to file this? Do you have to file that form? Someone's going to have to look at all those things. So that's going to be extra work. There's still going to be estate planning for U.S. citizens, just as there is now, because the U.S. estate tax isn't going away. And then we're going to have to be assessing whether people qualify to be a qualified non-resident citizen, like have they been in another country long enough, have they filed the right returns for the last 3 years, and again, planning for people moving to or from the U.S., trying to figure out, should they change some of their assets in order to not have to file a U.S. return anymore, just general planning, or when they move to the U.S., like what should they do with their assets to minimize their exposure to tax. And then again, there's still estate planning for non-U.S. citizens that have U.S. real estate. So those are just some of the planning opportunities. I've got a few more on the next slide, Max. So gift planning, again, gift tax is still going to be there. Then again, as Max mentioned, and we have the issues about determining whether a foreign corporation is a controlled foreign corporation, a passive foreign investment company, whether a trust is a foreign trust or not. So again, we're going to need more clarity on how do you determine the status of those entities when you have people that are qualified non-resident citizens and regular U.S. citizens that live in the U.S. Involved. So that's going to be additional work. And then expatriation advice, as I mentioned at the beginning, the U.S. expatriation rules are still going to apply to green card holders and U.S. citizens that either surrender their green card or renounce their citizenship. And I mean, maybe there's going to be less people that want to do this, but they still need advice before they do that. And advice on the bona fide residence test, again, that's just something we're going to be looking at. And then sourcing of income, as Matt mentioned, if you live in the U.S. and then leave, you're still going to have to pay U.S. tax on some of that income, even if it's foreign source, if you earned it while you were resident in the U.S. as a U.S. citizen. So there's still, I think, plenty of work to do. And I had a few additional comments. A couple more slides. Yeah, so I think Matt addressed the likelihood of success. I will not comment on that. Not qualified to do that. Again, the rules would only apply to tax years beginning after date of enactment, which could be a while, so people shouldn't get too excited yet. If you're living in a taxing country like Canada, there's probably limited benefit in terms of your tax liability because as Max and I both know, a lot of these people don't actually owe any tax. They just have a lot of filing requirements. But there might be a benefit for U.S. citizens living in tax havens, and maybe more wealthy U.S. citizens will leave the U.S. I guess Matt's not going to emphasize that when he's talking to the people. But that's, one of the issues now is that U.S. citizens don't move to tax haven, or they do, but they still have to file U.S. tax returns and pay U.S. tax on their income. And as Matt, I guess, touched on as well, corporations with expat employees might save on compliance costs. So if they're moving people around the world that are U.S. citizens, if they are qualified non-resident citizens, and if they don't have any U.S. source income, they might have a simpler annual filing than they currently do. So that might help people that are moving around the world, or at least employers of U.S. citizens that get moved around the world. And I think initially there's going to be additional fees for tax advisors in the U.S. and abroad. As I mentioned at the beginning, when the rules change, there's always additional work to figure out how the rules work and how they apply, and how the forms work and what filings are required. So I think in the very short term thing, nothing's going to happen. And then if the bill passes, there's going to be additional work for a few years until things settle down, and then some other law will change and we'll have more work to do again. So there's always lots of work to do for tax advisors. So I will leave it there, and I'll let you, Max, make any further comments.
I have no further comments, except to say you sound very excited at the prospect of future work.
Yeah.
So thank you very much, Benita, for that insightful overview of the rules and how they might affect tax advisors. Now we're going to go over to Terry Ritchie, and Terry's going to talk about some of the financial planning and investment considerations for American citizens living abroad and how they may be impacted by this proposal. And as discussed, Terry is a cross-border financial advisor and IRS enrolled agent at Cardinal Point Wealth Management. So over to Terry.
Great. Thanks, Max. Thanks, Benita. Good morning or good afternoon, wherever anyone is. Thanks for the opportunity to participate in this call. I think it's important, irrespective of whether the ultimate dream for many Americans who live and work abroad occurs. And Matt, good effort on your behalf. It'd be a nice result, I think, for many people. Although that being said, as Benita and Max know, and we all know, the net tax result for many U.S. citizens that live and work abroad in many cases could be nil, but the effort to get there is still quite a bit of work. So the administrative burden likely will still continue, whether these rules come to fruition or not. So what I wanted to do is to sort of, again, whether these rules come to fruition or not, wanted to talk about some of the things that we see from a financial planning perspective, and that we run into an awful lot for clients that live and work abroad. And so I wanted to touch on a few things today. I want to talk a little bit about some U.S. immigration issues, and then Benita talked a little bit, obviously, on the income tax issues, a couple other comments that I had. We'll talk a little bit about some investment management and banking issues that we often confront, some estate planning challenges that we often see that Max could also speak to, and then, what happens when clients or folks decide to move back to their country of origin, back to the U.S., and what kind of planning considerations need to be thought about from there. So next slide, Max. So I just wanted to sort of reintroduce the fact that it's not uncommon that Benita and Max and myself, work with folks that are in what we refer to as mixed marriages, folks that are U.S. citizens married to a non-citizen spouse. So if Matt's successful and these rules come to fruition, the TFAA does come to fruition, then the planning opportunities that would exist would apply to just the U.S. citizen. The non-U.S. citizen spouse obviously wouldn't apply to them. And then if you have individuals that are married couples where one has a green card and may be living abroad with a reentry permit and chooses to return, and the tax laws do change, the planning opportunities for that type of individual will not apply. So we do need to be cognizant of the fact that we may be in situations where couples may fully be able to benefit from these changes, and some couples, by virtue of the nature of their immigration status U.S.-wise, might not benefit as much. As Benita mentioned, the expatriation tax rules that presently exist would continue to exist under the proposed legislation. However, what might apply is that the mark-to-market gains might not apply to foreign property that accrued while these rules kicked in, and so that's something that might be a benefit for folks that might have to pay some mark-to-market tax and expatriation tax. And then I think Benita also touched on gifts that you might have from folks that parents or persons that did previously renounce. If a QNC received a covered gift or bequest and it came from a foreign source, might that be excludable as foreign earned income under these rules as well? So things to think about as part of the longer term planning if these rules come into play. Next slide. So as I say here on the slide, so Benita did a good job of outlining what would not change, the ongoing compliance requirements, and some planning opportunities. I think most of us, we've been banging the drums here for a long time related to the various programs that have been put in place by Treasury and by the IRS to encourage U.S. taxpayers, U.S. citizens to come into compliance. It still amazes me that every month we still bump into folks that have kept their heads in the sand and just haven't drank the Kool-Aid yet. But certainly, if these rules do come into play here, it's certainly going to be a great encouragement for folks to get compliant, because you've got to prove full compliance, as Benita outlined and Matt outlined as well. You have to be fully compliant for 3 years. So if you're one of those rare persons that is still sort of on the sidelines, this might be one of the things that would encourage you to get compliant. And as we know, it's likely that these programs are not going to stick around forever. There's obviously been some adjustments over the years. So if you know somebody or you're one of those folks, we'd encourage you to talk to somebody about getting compliant and getting ahead and becoming a qualified QNC when these rules come to fruition in the future, if that's the case. Next slide, Max. That being said, since Benita and Max and I, we primarily work in a Canada-U.S. context, there are a number of other compliance requirements that still would likely exist for those that live in Canada and may participate in TFSAs, which is the acronym for tax-free savings accounts, which are somewhat similar to Roth IRAs in the U.S., or RESPs, which are registered education savings plans, which are similar to 529s from an education savings perspective. So there'll still likely be requirements that relate to that. But given the fact that the income that accrues within those plans are presently taxable for U.S. taxpayers, U.S. resident taxpayers, now that they're foreign source, might that income that we have to pick up for accrual purposes now be exempt from U.S. tax, having to pay U.S. tax on that, outside of the fact that there would be the compliance requirements as we see here, the 3520 and the 3520As. With respect to entities and mutual funds, so Subpart F and GILTI and PFIC distributions, those distributions would appear to be foreign unearned income and therefore would likely be excluded from taxation if you were a QNC and if these rules kicked in. It's likely that, again, as Benita mentioned, that the 5471, the 8892s, the 8621s would still need to be filed. And it would be interesting to know, for those folks that had the pleasure of having to pay a transition tax last year, whether they paid it in a lump sum basis or over the next 8 years, if this law were to pass before the 8 years are up, before 2025, would there still be those installments that have to be required under the transition tax, under the 965 tax? Would that still apply? And then, as Benita mentioned, there's still going to be that administrative burden that we're all going to have to help clients with, or you're going to have to face in terms of the foreign disclosure requirements on the 8938 and the FinCEN 114. Kind of a pet peeve for me, because I've been doing this an awful long time as well, is that, you know, we often bump into folks that have the obligation to file tax returns in 2 jurisdictions, and I just think it's really important that you find one tax practitioner that has a good sense of what's going on, because we often find mistakes being made when the 2 practitioners, one in Canada, let's say, for example, and one in the U.S. is doing the returns, and they're not properly talking to each other, not optimizing foreign tax credits and things like that. So I just strongly encourage that you try to have one qualified practitioner do your tax work for you. I think that there's a lot less chance for errors that come into play in that regard. Next slide, Max. So as many of you likely know that are on this call and are no longer living in the United States, you know, many of the large U.S.-based institutional custodians and retail custodians are not comfortable any longer working with U.S. citizens who live or work abroad and have a U.S. physical, or sorry, a non-U.S. physical presence. And so many of you might have been reached out, may have had your custodians in the U.S. reach out to you and tell you that, you know what, we're not comfortable working with you any longer. And we're talking about very, very large custodians in the U.S., you know, brand names that we would all know and see advertisements on TV and whatever. And so what we've started to see now for the last number of years is clients that are contacting us or other firms that are qualified to work with these folks, and it's going to impact retirement accounts. And the reason is that, again, a lot of these firms in the U.S. don't have regulatory licensing or requirements in Canada to allow them to conduct or transact business on behalf of folks that live in a different jurisdiction. And irrespective of how large these accounts are, they're not comfortable. There's a significant amount of liability. And so they're what I call booting these folks off of their platforms. And so that's something that is creating lots of problems for a number of folks that live and work abroad. And so the other challenge that we have there is that these accounts, in some cases, they may not be booted off the platform, and you might not be told to go find another custodian that might be more comfortable with you, or that might be licensed or registered in the country that you're physically living in. But the accounts may have been restricted. So you can keep the account here, but you can't do anything with it other than sell it. So that can create some challenges from a financial planning or investment management perspective, because you're going to be limited in your ability to rebalance a portfolio. If you were lucky enough to participate, as many people were in the previous in the last quarter of 2018, where markets weren't kind to everybody, and some people may have been wanting to make some changes in their portfolios. For clients that have accounts restricted, there was that inability to do that. So it's important that you're able to find a custodian or an advisor that's going to be able to help you fulfill your investment objectives and not have your hands tied with feather handcuffs there. And of course, you know, if you're going to be booted off the platform and told to find another provider, and you can't move those assets over if they're non-qualified or taxable assets, and you have to move them to another platform, another advisor, or another custodian, there may be some adverse U.S. income tax consequences, and in many cases, Canadian consequences or other jurisdictional consequences, as well because of maybe realized capital gains that have to be created, and maybe even the requirement to go ahead and take money out of your retirement accounts early. So you need to be aware of those issues also. Next slide, Max.
Terry, just a question for you on this slide, if you don't mind. And I think the answer is no, but just to put it to you directly, the Tax Fairness for Americans Abroad Act doesn't change any of these problems because these are securities legislation problems, correct?
Correct. That's correct. Yeah.
All right.
Last couple other issues too. This is another sort of pet peeve and things that we see, games that we see people playing, and that is that you're living in Canada or the UK or someplace else, and you've got a family member, a friend, and or a post office box using a UPS box or whatever. And so ways to sort of overcome some of the challenges that these U.S.-based custodians are imposing on folks that live no longer in the U.S. is to go ahead and put somebody else's address on that account. And that creates problems. First of all, if the compliance officer of these institutions was aware that you were living in Canada, but yet you were using a U.S.-based address, again, you're not licensed they're not licensed to work with you if you're in Canada or some other jurisdiction. There's regulatory guidelines that come into play here related to that. So that's one fact. And then the other thing too that we've seen in some states, the states need dollars, and so California is aggressive. Other states are aggressive. So if you're saying that you live in California, and then you truly live in Alberta, and you're using a California address on there, when the 1099 packages come out, they're not only going to the IRS, to the feds, but they're also going to franchise as well. So we've seen situations where various state jurisdictions have sent letters off to individuals that live in Canada, let's say, for example, and say, we've received information suggesting that you had realized gains of this amount or investment income of this amount. We don't see a tax return here. So we've got to sort of resolve those issues. So we need to be aware of those kinds of games that are played around that and try to diminish that. And of course, estate planning considerations, if you're using an alternative address. If you're truly living in Canada and you've got an account in Colorado or some other place, and you become loopy or you die, you become an angel, then obviously there's some estate planning considerations that can come into play that might be created through using a different address. And of course, it depends on your estate planning documents and how the property is titled and things of that nature. It's also important that to recognize that if you're living in Canada, let's say you're a resident of Canada for tax purposes and you're a U.S. citizen, so you're a resident of the U.S. for tax purposes, it's important to have your investments aligned, and you need to make sure that we have a proper accounting of your cost basis, as Benita mentioned previously, and I think Matt mentioned as well. You're going to be, if these rules come into play, there's going to be a tax basis that we'll have to sort of pick up because, as Matt said, it's on property. Any gains that would accrue after this law passed would have to be accounted for because there would be some tax implications upon maybe the ultimate sale of that property that would be different for U.S. purposes under these proposed rules. And if you're coming to Canada for the first time and establishing residency here, we know that there's a stepping up of cost basis for investment accounts. And so it's important that we have somebody that's sort of keeping track of that stuff for you. And the other thing too is you need to be aware that if you move to another country and you've got U.S.-based investments, they may make sense when you were in the U.S., i.e., certain variable annuities or municipal bonds or things like that. But in Canada and other places, they may not make as much sense for you, and so you need to be aware of those issues depending on where you ultimately find yourself. Next slide, Max. So banking is obviously an issue that comes into play an awful lot, and a lot of clients or individuals, ask, should we just sort of stick with our big bank, and do we get a lot of convenience there? And certainly all the banks in Canada and the U.S. are pretty convenient from a currency or foreign exchange perspective. I'm a big advocate of going the wholesale route rather than the retail route, even though the convenience on the retail side makes sense. So there's a number of I sort of use the acronym, the Costco of currency exchange. There's a number of wholesale currency providers that are available that you can work with, very large firms, and they effectively are the middlemen between your U.S. bank and your Canadian bank or other country bank, and so they can be very effective for you, and you can save significant amounts of money in working with these firms. we have relationships with a number of them. We have no hidden agenda. We get no finder's fees or commissions by recommending any of these firms, but we're big advocates of encouraging folks that are looking to exchange dollars to work on the wholesale side as opposed to the retail side, even though the convenience typically is there. The retail side can make sense if you're a pretty significant private banking client with certain banks, but generally we still find that the wholesale side, or even working with certain custodians, can often give you some spot rates as well that can make a lot of sense. And then from a banking perspective, again, working with some of the banks in Canada that are affiliated on the U.S. side can make sense, and vice versa. That can help clients make life a bit more meaningful in terms of cash flow management and paying bills and things like that. And so we have to be cognizant of making sure that when we work with clients that live and work in two jurisdictions or and have expenses in various jurisdictions, that we can manage their cash flow properly, whether that be on the banking side or whether that be on the investment side as well. Next slide, Max. Just wanted to talk about just some finally on some cross-border estate planning, mistakes that we often see. I think the biggest thing is that Benita and Max and I often see is that there's no proper coordination. You'll just focus on one area of your overall financial plan, and it's really important that the planning efforts are looked at in totality. We often see that clients might have documents that were drafted while they were living in one jurisdiction, then they moved to another country, another jurisdiction. It does make sense to have those documents looked at, because it may not meet the new jurisdiction's needs properly and things of that nature. The kind of planning that we can do on the U.S. side, the use of revocable trusts and inter-viabilis trusts, can make an awful lot of sense on the U.S. side, but it doesn't make much sense in Canada. We have different rules that come into play there. So we have to make sure that we can coordinate the estate planning documents for folks that come into play. And as we talked earlier about on the estate planning side, in mixed marriages, planning for U.S. citizens versus non-citizen spouses have to be looked at, and that can be ignored sometimes. When you come to Canada, the presumption is that if you're in Canada, you're Canadian residents, and the practitioner may not ask if you're a U.S. citizen, or vice versa. If you move to the U.S. and you're sitting down with your estate planning attorney, the presumption is that you're a U.S. citizen because you're in their office and you're in that country. So it's important that the planner needs to be aware of truly what your citizenship is and what your status is from an immigration perspective in both Canada and the U.S. And then gifting is different, as we know, in Canada and the U.S. and other jurisdictions. So we have limitations on the U.S. side in terms of how much one can give away to a non-citizen spouse or to your children or to new friends and things of that nature. And if you go beyond that, there are some gift tax filing requirements. If you make gifting and you happen to be a U.S. citizen resident in Canada, there's going to be a tax result depending on what type of gift you're making, and so we have to look at that. We also need to be aware of the titling of assets, and sometimes we may have good estate planning documents, but yet we still have the assets titled joint tenancy. So it's important that we make sure that we're engaged with our estate planning attorneys that we work with to ensure that the estate plan that's been drafted, whether it be down there, i.e. the U.S. or in Canada, is going to work in light of how the assets are ultimately titled in the country of jurisdiction where those assets are. And incapacity and loopiness. It's a real world, real things happen. People become angels. People bump their heads and aren't as rational as they used to be. So we need to have documents that come into play with respect to that. Where you may have property in the U.S., those documents need to come into play there, and property in Canada as well, or whatever jurisdiction you live in. Next slide, Max. Again, life insurance is important. Again, if you're living in Canada and you've got U.S. dollar life insurance, again, there's compliance requirements relate to that. There's beneficiary planning with respect to that. Does it make sense to own it through a trust? Life insurance might be, you might be back in the U.S., living in the U.S., and you happen to have Canadian dollar life insurance. Is that going to be adequate enough to fill your U.S. dollar requirements? So it's important that we look at those kinds of issues. We find life insurance to be a bit more cost-effective from a mortality cost perspective in the U.S. than in Canada, and so it's important to look at those issues. Planning issues for green card holders and dual citizens, we talked about that earlier. Max and Benita and I often bump into folks who become beneficiaries of wealth that are living either in the U.S. or Canada. How do we plan for that? How do we move money? If you're a beneficiary in the U.S. and your mom or dad passes away in Canada and you've got Canadian dollars, does it make sense to go ahead and make that conversion to U.S., or can you leave it in Canada? Can you move it to the U.S.? How do we deal with those issues? Max wrote a great article last week in one of our industry publications here in Canada related to the issues related to non-resident executors and trustees of states in Canada. So that can be a bit of a challenge. As we know, as Benita talked about, even though it would be awesome if these rules change so that foreign sourced earned and unearned income would only be taxed, would not be taxed under these rules. The estate tax rules still would exist. And as we know from all of these years, the estate tax has been a moving target. We have a presidential election coming up in 2 years. We have a potential different Congress as well. So these rules could change. And if these rules change, they certainly could impact some of the things that you presently have with respect to your own estate planning and financial planning, given that the exemptions could change in the future, or they will what we call sunset in 2025 as well. So we need to look at those issues. And some of the presidential candidates right now are suggesting various wealth tax proposals that could come about in the future. And what impact might that have with respect to our financial or estate plans as well? We need to continue to be aware of all of these issues and follow them. Next slide, Max.
Yeah, Terry, I just wanted to ask you a question at this point. And it's a simple one. It's that all of these complexities on the cross-border estate side aren't changing with this legislation, right? These remain live issues.
That's correct. So, I mean, it would be awesome if these. I mean, certainly, as I said at the very beginning, the net tax result for many of the folks that we're talking today might be rather low. There may be no tax on the U.S. side because of the level of tax we ultimately pay in their country of residency, whether it be Canada or someplace else. But the administrative burden still comes into play. If these laws do pass, these issues that have been talking about for the last little while still are going to come into play. We still need to be aware of them. We still need to plan for them.
Terry, if it's okay with you, I was going to transition to questions because we've got a bunch. But let me just say thank you to Terry, Matt, and Benita for that those excellent overview of the rules. I think my takeaway of listening before we go to questions from all three presentations is essentially this is a good step and it will improve in a material way the lives of U.S. citizens in Canada, but tremendous complexity remains, right? We have the forms and all the transfer taxes that Benita talked about, the green card issues Benita talked about, and then all of the financial and estate issues that Terry talks about, and none of those are going to go away, even if this legislation passes. And so it's a good start. Before we go to questions from the audience, and we've got a lot of good questions, I just wanted to say, Terry, Benita, Matt, do you have any questions for each other or comments, other comments you wanted to make after having listened to the rest of the presentations?
It's Terry. I have a question for Matt. So, Matt, what can folks that are on this call do to help your initiative here? What kinds of things can be done, if any, at this point in time?
So two things. I think one, providing feedback on the legislation to us is extremely helpful, and any sort of issues that you guys still see that would be around afterwards, bring those to us, because we also do view this as a first step, and we want to subsequently down the road continue to work on the problems that are going to affect this group of people. So keep bringing those to us or any other member of Congress that'll be interested. But two, with regard to the specific bill, get out, and anybody that you guys might know, member-wise or group-wise, that would be able to push this. Really, anybody just banging that drumbeat anywhere that they can, especially with members that they might know or have a personal relationship with their office. That would be extremely helpful. And please feel free to send them our way if they express interest. We're happy to talk to any office or anybody that has an interest in this. Really, just helping raise the profile of this issue is huge for us.
Great answer. Benita, Benita, Terry, Matt, any other questions before we go to questions from the audience?
I'm fine. Go ahead.
I'm good.
You're good. Okay. Charles, any questions from you? No questions from Charles. Okay, questions from the audience.
I'm fine.
We have a lot. So, First question is, how do these rules apply to green card holders? I mean, I think, Benita, you touched on that. Do you want to just give a quick answer?
Well, I think there's no change for green card holders. So whatever their situation is currently, it continues.
Second question, does this mean we would be able to invest in TFSAs or ESPs that have been considered foreign trusts? And as well, would the whole PFIC issue go away? I mean, Terry, you talked about this a little bit. You want to just repeat what you said?
Yes. So as we know, for the traditional way to deal with this for U.S. citizens is if you invest in TFSAs or ASPs, is that the income, the accrued income would be taxable for U.S. income tax purposes. It could be tax managed to a certain extent depending on the kind of underlying investments that one is using, but it's taxable for U.S. purposes on your 1040s. There would be the requirements to file the 3520s and the 20As. I do know that there are some practitioners that chose not to go the 3520, 3520A route and are submitting statements instead, substitute statements to deal with these issues. But conceivably, as my slide indicated, if the income that's accruing within these plans would be foreign sourced unearned income, then conceivably they would not be subject to tax. The compliance requirements likely would continue to exist, but the tax on the accrued earnings that we have to pay now probably would go away. That would be my interpretation.
That makes sense. Next question. So if I purchase a home after I move overseas, I won't have to pay capital gains tax. This is a big issue for Canadian resident U.S. citizens because Canada offers an unlimited principal residence exemption, and the U.S. exemption is more restrictive. Benita, what do you think?
Well, as long as the house is not in the U.S. Yeah, like it should be. If you are a qualified non-resident citizen and you live outside the U.S. and you sell your home, it should be foreign source income and it should not be taxable in the U.S. if you're one of these qualified non-resident citizens. So that's a good thing. I mean, I think Vancouver and Toronto are kind of unique because house prices have gone up so much. I don't think it's as much of an issue in a lot of other places. But
yeah, I think we all have clients over the last number of years from Vancouver or Toronto that would have loved to have this legislation into play, when they sold their properties, right? So.
Right.
This is a good question, and I'll flip this over to Matt. Do you have to meet under the proposal? Do you have to meet the bona fide or physical presence test every year to receive the tax relief? And how many days a year can you visit the U.S.?
Yes, you will have to meet that test every year, one or the other. So you sort of get to pick. If you are living abroad, the bona fide residence test should be easier for you to meet once you actually meet in that physical presence test. But you'll be able to, those residency requirements will sort of mirror the 9/11 residency requirements. So that's what we've drafted on currently. So similar to how long you're allowed to visit the United States now.
And a follow-up from me on that. I mean, do you have any, like the bona fide residence test is a little bit fluid, and to my knowledge, there's not a ton of cases on it. I think there's some, but there's not a ton of cases on it. Do you have any, I mean, first of all, I think it's very elegant to incorporate it into the existing 911 rules. But do you have any worries about borderline cases or lack of clarity on that aspect of the legislation? Or?
Not as much with regard to bona fide residency. No. The issue that we more ran into with 9/11 is the abode definition, and folks that still had a home here in the United States, and then being disqualified because they didn't have a tax home. Their tax home was considered the United States, not abroad. So that's more what we've ran into than the residency, the bona fide resident requirement. So, I mean, that's one we'd certainly, as we define tax home, make sure to define clearly to not run into those problems. But we haven't heard sort of that same concern yet about bona fide residence. But I mean, if it's out there, we're happy to address it.
But it would be interesting to say, like, you have to be a tax resident of another country, like, and filing tax returns there, or if that country doesn't impose tax, you have to be legally resident there. Like you can't just hang out somewhere and not be a legal immigrant or resident. But anyway, I mean, you're probably trying to get there anyways. But
Yeah, we are. And as we were sort of going back and forth with JCT, we had originally thought about putting that in there, and then they did not always like the onus being on what is or is not a resident of another state. They sort of wanted to define it by our own terms rather than by the different laws of different countries.
okay, that's interesting.
But that's sort of why we stuck with 9/11 requirements, is that it was already in place and was something that they were able to conceptualize and deal with more easily, or the IRS was rather.
That makes sense to me. As you said, one of the elegant, from my perspective, one of the elegant things about the proposal is that you're not rewriting the entire tax law in order to accommodate this change, right? You shoehorned it into an existing proposal, which I think certainly makes it simpler to explain. But that's just my perspective. Okay, next question. Does the bill contemplate prior tax years where income tax would have to be applied to U.S. citizens living abroad solely because of their U.S. citizenship? So the examples given are net investment income tax, transition tax, and GILTI. Matt, do you want to take this one? Basically, I think the question is, if you have a problem, if you have a U.S. tax owing in a prior year that you wouldn't owe after the bill was passed, is there retroactive relief?
Not necessarily. I mean, the way it's drafted, you won't be subject to GILTI under the bill as introduced, because that'll be all foreign income. The transition tax, that's sort of already sort of said and done, and you'll have paid that. I guess some relief could sort of be taken by any valuation of any business that you might have, if that would have to be sold off as a part of an exit tax. But I mean, that's not necessarily in the bill as drafted. So I think the answer is, if I'm understanding the question correctly, is no, there won't be any retroactive relief for that transition tax as a part of this bill.
Any other comments, Terry, Benito, on that point?
It's Terry. So no, I think that would make sense. Like I said earlier in one of my slides, is that if you're making your 965 tax, the transition tax on the installment basis, and this law were to come into play 3 years from now, you still got 5 years left or 4 years left or through 2025. I presume to still make those installment payments, even though technically the law doesn't no longer exist, I guess. So
it's Charlie. I'll just comment that if you go into retroactive relief, one of the fallouts will be the number, the revenue loss will go up, and I think most of us think they're going to have to be really paying attention to that subject very, very closely.
That makes sense to me. So next question, unless there are other comments on that topic, and we touched on this a little bit, but maybe we can hear a bit more from Matt. This question for Matt: what is a realistic timetable for this bill to move forward? And I don't know, Matt, if you have any other comments about future progress that you want to add to the ones you already made, or.
Yeah, I mean, if I could answer that question, I'd be getting paid a lot more than I am now. I wish I knew. We're sort of waiting for some stars to align here, but I mean, we're trying to get a Democratic co-sponsor now, and then get a bill out as quickly as possible once we do have that Democratic co-sponsor identified. And then from there, it is sort of up to leadership, up to the Ways and Means Committee leadership as well to help push this bill forward. So that becomes a whole different hurdle. So I don't have a timeline of when this thing could possibly move through the House. I mean, we're going to get this introduced and then keep pushing as hard as possible to try and get it on any vehicle. But I mean, my guess would be that it would, given the gridlock that's going to happen in Congress for this session, it would probably be after 2020, unfortunately. But never say never.
There's a question, and we touched on it a little bit. There's a couple of questions about whether the legislation would exempt U.S. citizens abroad from the various other disclosure forms, 5471, 8858, 8865, 8938, 926, etc. Benita, Terry, comments on that?
I don't have any.
I think our conclusion was no. Do I have that right?
Yes.
Okay.
I'll just contribute the thought that it may be a little premature to get too much into the detail, because there are going to have to be a lot of subtle or not so subtle changes in the in what you see now, and that's exactly what Matt and other people are working on right now. So I think everybody's done a tremendous job dealing with the fact that there's not a lot of tiny detail in some of these areas.
Question: will the 3.8 net investment income tax continue to apply? I don't have an answer on that. Anyone else want to take a stab at that one?
I think I saw somewhere someone saying that it should only apply to your U.S. source income.
I agree as well. I think I saw that same thing too.
I don't know if
it's sourced. If I thought I saw something in the proposed legislation related to if it's U.S. sourced income, the net investment income tax would still apply.
Matt, any comments on the net investment income tax, the 3.8% surtax on investment income?
Yeah, I think y'all are spot on. It will still apply to U.S. source income. That's a costly one to repeal, unfortunately.
But not foreign source income.
We don't envision it as such. It would still be on the U.S. source, but
right.
We don't envision it on foreign source.
Which would be awesome for a number of the clients that we bump into, because that's in many cases the sole level of U.S. tax that they've maybe had to pay over the last number of years or since the NIT tax came out. So.
Agreed.
Yeah. Next question, it says, suggestion. In the next iteration of the bill, it just says deal with the 50K threshold for passport revocation. I don't know, Matt, if you want to make a comment on that. We have in one of our. So go ahead.
So that was put in place, I believe, as a revenue raiser, as a part of maybe one of those highway bills or some sort of transportation bill, I believe. I think I have that correct. But I think we'd have to look into the revenue impact that would come along with that to see if we could repeal it as a part of this. I mean, we definitely heard it as a problem raised by the community and something that we would like to address. I think we'll just have to gauge the revenue impact and how that would affect the bill. So it's not a definitive yes or no.
On the sale of a PFIC and whether that would be modified by the legislation. So basically, you live in Canada, you own a PFIC, you sell a PFIC right now, the results are nasty in the U.S. Does that get better? Benita, I think you touched on this a little bit.
Yeah. I mean, I think it should, because it should be foreign source income, because a PFIC is generally, it's a Canadian company or a mutual fund. So I'm assuming it would be foreign source income. So as long as you were a qualified non-resident citizen that year, that you should not be taxed in the U.S. on any gains or income distributions from a PFIC.
Next question. What is the impact on non-qualified foreign pension contributions, employee and employer, during years of employment and during retirement? And then the preface is, what about the U.S. taxes I already paid over so many years on employee and employer contributions? And
well, lucky. I mean, I think that in when if this law passes and if you're a qualified non-resident citizen, you should not have to pay tax on that because it's going to be foreign source pension, right? But you're still going to have to
Right.
report it on your 8938 that you have it, but I don't think it would be subject to U.S. tax because it's foreign.
And that would be a solution. One of the big problems faced by Americans who don't live in Canada but live in other countries, Australia, France, Switzerland, is current U.S. tax on the pension, and so that would be an issue that this legislation would solve, right? Which
Right.
in Canada we don't have that for our clients. We don't have that problem because we have a treaty that fixes it.
Right. I mean, I think we're kind of focusing on Canada and the US just because of where we are, but for sure, like there's going to be different benefits and different issues in every country in the world, right?
So question, what are Matt's current thoughts on transition rules for capital gains on foreign assets? That is, current non-residents have foreign assets acquired after leaving the U.S., but before qualified non-citizen status was available. Will the gain on those assets be subject to U.S. tax?
So that's a good question. Under the bill as introduced, they would be subject to capital gains on those as they sell the asset. One of the things that we did when we introduced this bill is it took us a while to get with Ledge Council and drafting to get to the point that we were at. We went through a number of iterations to try and figure out how to get an appropriate base rule. We had a much broader or a much larger proposal rather that had transition rules for Americans already abroad and a couple other walls in this thing. And in drafting, it was super complicated, so we tried to focus on getting the base rule out first. So we did not address any sort of transition rule for Americans currently abroad at the time that the law would pass. That is something that we're still working on and trying to address, and whether that's an income threat or geez, my brain is not working. It's late in the day here. Not income threshold, but sort of as the expatriation tax is. If you make more than, or you have a net worth rather of over X dollars, you do not have to pay any sort of tax associated with the investments abroad. Or if you have a tax liability that is under X per year, you do not owe any tax on the investments that you have abroad. So we're looking towards some sort of transition rule like that. We're trying to figure out where to set those thresholds at, and going back and forth with JCT to figure out what the right policy would be and where that right number would be, both to exempt as many people as we can so we don't clear out folks' retirement accounts in this transition, as well as make sure we don't have a huge revenue loss. So that's one that still needs to be addressed, and we hope that that'll either be in the next iteration of the bill or as we move towards actually pushing the bill through a markup process and getting it into a larger package. So it's definitely something we are looking to. It was not addressed in that other iteration of the bill.
So on our last question is a very specific one. Foreign mortgage exchange gains should not apply going forward, but on accrued. Question. So gains on foreign exchange gains on mortgages. Benita, any thoughts on that one? That's a tough one.
I mean, I think it goes with what Matt was just saying now, is like it is foreign source, but to the extent that it accrued, I guess, while you weren't yet a qualified non-resident citizen, there's probably going to have to be some kind of transition rule, right? I mean, this is the issue where people borrow money when the exchange rate on their mortgage is at one level, and then when they repay it, they have a gain in US dollars and they have to pay tax on that. They're not very happy about it. But I mean, I guess going forward, if you borrowed money after these rules passed and you're a qualified non-resident citizen, then it would be foreign source and it wouldn't be taxable. So again, it comes back to what's the transition rule going to be for people that had the mortgage before these rules came into place, which is, I think, the same question as the previous one. they're going to have to figure out some thresholds and limits and how to implement it how to make a transition work, I guess.
So I think with that, we're going to wrap up the question period. I just want, and before I turn it over to Charles, I just want to say, Benita, Matt, Terry, thanks so much for a lively and insightful discussion on, on sort of work in progress legislation, but that's really important. And then I'm going to turn it over to Charles and Mary Louise for a final comment here.
Okay. I want to add my thanks to everyone and to everyone who's participated. I want to say just something quickly about the subject of likelihood of success. I'll give you my view. I think it's shared by a lot of people at ACA. That is, if people sit on their hands and don't do very much, then the likelihood of success really goes down. However, if people are active, get active, push for this, then we believe that the likelihood of success is actually good, actually surprisingly good. And if it is tax neutral, if it is tight against abuse, if no one is really worse off than they were before, what we've experienced, and Mary Louise and I and others, as Matt well knows, travel up and down the corridors on Capitol Hill, we get the feeling that this is absolutely possible, absolutely doable, but it is going to take effort. Mary Louise, can you wind us up now?
Yes, I just want to add my thanks to Max and Matt and Terry, Benita, and you too, Charles. These webcasts we think are really important in helping to get the messaging out there and also helping the community understand what's going on in Congress and what Matt and his boss are doing, and what the community is doing to support this. And I wanted to add to Charles' comment as well about a lot of people I know are anxious about timing and when is this going to happen, and they wish it could all happen tomorrow. And of course, it is a process that has to go through its steps. But we are in a really almost historic place that we have had this work done on the legislation. As Matt noted, his boss has been working and thinking about this for 4 years. We have legislation introduced. We have the key offices in Congress working on this actively. We do have support, as Matt noted, up on the Hill, and ACA, along with other organizations, has obviously been knocking on the doors and educating. But to Charles' point, we need the support and help of the community, and that's what's going to help a lot of this push across the line at the end. So again, thank you to everybody. And just to remind everyone that ACA, American Citizens Abroad, is the advocacy organization of ACA. We do a lot of work on a lot of issues, not just on taxation. We encourage people to take a look at our website and learn about the other work that we're involved in on citizenship and voting and other issues that are affecting U.S. citizens living and working overseas. ACAGF, which is an American Citizens Abroad Global Foundation, is the educational and research branch of ACA, and they are the sponsors of today's webcast. Pay us a visit there and see about the work that we're doing to get more data and research on the community. I guess at the end of the day, all we can say is please help support these efforts. Consider joining ACA. And again, take a look at our websites, take a look at our work, and thank you everyone again for being on this call.